The Federal Reserve, the central bank of the United States, pulling the strings to the U.S. economy for more than a century. Back in 1913, after major panics and recessions, Congress and President Woodrow Wilson created the Fed to keep things in check. Over the years, Congress tweaked the Fed's responsibilities. After the Great Depression and other crises made it clear how the Fed could better steer the economy.
In the late 70s, Congress explicitly said to the Fed, you have two goals here, price stability and maximum employment.
Price stability and maximum employment, the two big goals of its monetary policy, which it largely does through the tool of interest rates. Here's how the Fed's structured. There's a central board based in Washington, D.C., with 7 members appointed by the president serving 14-year terms. Right now, its chair is Jerome Powell.
We have raised interest rates by 4.5 percentage points.
Picked by former President Trump and reappointed by President Biden. To get a better pulse on how different regions are doing, there are also 12 Federal Reserve Bank outposts scattered across the country. 8 times a year, the central board members and Federal Reserve Bank presidents get together in D.C. for these Federal Open Market Committee meetings, where they decide on what to do with the federal funds rate. That's the interest rate that banks borrow at overnight.
That rate then influences all the other things in financial markets.
Banks use it as a benchmark to base the interest rates they charge you on things like mortgages and credit cards. So if it's worried about inflation, the Fed might increase rates to make borrowing more expensive, putting a damper on spending throughout the economy. But if it's concerned about a recession, it might do the opposite and lower rates to encourage people to buy more stuff and companies to invest. The Fed does this with its dual mandate in mind, stable prices and maximum employment. And it doesn't answer to the president. It's independent of the White House and Treasury. Now, the Fed does more than change interest rates. It supervises banks, visiting them, making sure they're following the rules, and sometimes slapping on penalties when they aren't. Since the 2008 financial crisis, it's paid particular attention to the bigger banks.
Silicon Valley Bank management failed badly.
The Fed also notably issues the cash you use on a daily basis and works to keep the payment system safe. A lot of responsibilities for a central bank steering the world's largest economy.
Brian is joining us now. Brian, that's a great breakdown, helping people understand what this is all about. And the big question, of course, tomorrow, what are they going to do with rates? The expectation is keep them as they are. So is that like a good thing if you're trying to go buy a house, if you want those mortgage rates to drop a little bit?
Yeah, and that's what the Federal Reserve has telegraphed, which is the reason why markets are pricing in a 98% chance, basically a foregone conclusion that they won't raise interest rates at the conclusion of their meeting tomorrow. For what it's worth, the expectation is the Fed could begin cutting interest rates later on this year. That might provide a little bit of relief on those mortgage rates and those credit card rates that we've seen have been so high. Again, if we're kind of thinking about the airplane analogy here, as you get towards that intersection, you don't want to just be brake checking into it. You want to be softening into it. That's the reason why they might be lowering those interest rates again, as we discussed, that lever that they have to control essentially what direction this U.S. economy is going, especially after the big shock of the pandemic, Hallie.
Thanks for watching. Stay updated about breaking news and top stories on the NBC News app or follow us on social media.